Investing can seem like a daunting task, but by following a few simple rules, you can set yourself up for success. Despite being careful and following guidelines, investing still carries a certain degree of risk, and it is impossible to guarantee that you will get back more than what you put in. Investing successfully can be achieved by avoiding common mistakes, but emotions can make it difficult to stick to a strategy. The phrase buy low and sell high is well known, but our emotions can lead us to make the opposite decisions. Making money in a rising market is relatively easy, but it takes a well-thought-out long-term strategy to navigate choppy markets and come out ahead as an investor. Here are 6 rules of investing that will help you navigate the market and achieve your financial goals. Number 6. Start early. The power of compound interest is one of the most important concepts to understand when it comes to investing. Compound interest is the interest earned on the original principal, as well as the interest that has accumulated over time. The earlier you start investing, the more time your money has to grow and the more compound interest you can earn. For example, if you start investing $100 a month at the age of 25, by the time you reach 65, you will have invested $180,000 and earned $254,000 in interest, assuming a 7% rate of return. However, if you wait until 35 to start investing, you will have invested the same $180,000, but earned only $141,000 in interest. Number 5. Diversify your portfolio. Diversification is key to managing risk in your investments. Diversification means spreading your money across different types of investments, such as stocks, bonds, and real estate. Each asset class has its own unique set of risks and returns. By diversifying your portfolio, you can reduce the risk of losing all your money if one investment performs poorly. For example, if you invest only in stocks and the stock market experiences a downturn, your entire portfolio will be affected. However, if you also have investments in bonds, which tend to perform well in a down market, your portfolio will be more protected. Number 4. Understand the risks. As we mentioned earlier, all investments come with some level of risk. It's important to understand the risks associated with different investments and to be comfortable with the level of risk you're taking on. Before you invest in anything, research and educate yourself about the investment opportunities. Understand the potential returns, but also the potential risks. This will help you make informed decisions and ensure that your investments align with your risk tolerance. Number 3. Keep your expenses low. High fees and expenses can eat into your returns. When investing, it's important to be mindful of the costs associated with different investment options. Look for low-cost investment options, such as index funds, which have lower management fees than actively managed funds. Also, be aware of hidden fees, such as trading commissions, that can add up over time. By keeping your expenses low, you can increase the amount of money that goes towards growing your investments rather than being eaten up by fees. Number 2. Have a plan. Before you invest, it's important to have a plan in place for how much you want to invest, when you want to invest, and what you want to invest in. This plan should be tailored to your financial goals, risk tolerance, and time horizon. Having a plan and sticking to it will help you stay focused and avoid impulsive decisions. It is also important to review your investment strategy regularly to ensure that it still aligns with your goals and that you're not taking on too much risk. Number 1. Stay patient. Investing is a long-term game. Don't get caught up in short-term market fluctuations. Stay patient and stick to your plan. The stock market can be volatile, and it's not uncommon for it to experience ups and downs. However, over the long term, the market has a tendency to trend upward. Don't make hasty decisions based on short-term market changes. Instead, have a long-term perspective and stay invested. Remember, investing is a marathon, not a sprint, and by staying patient and sticking to your plan, you can help ensure your investment journey is a success. Investing can be a challenging and emotional journey, and managing those emotions is crucial for success. It's important to avoid making impulsive decisions based on fear or greed. One way to help keep emotions in check is to focus on the fundamentals of the investment rather than getting caught up in short-term market fluctuations. With a clear strategy and a level head, investors can navigate the ups and downs of the market and make sound decisions for the long term.